maybe you can tell us a little bit about how this will affect Wall Street, because I don't know if this means we'll see less M&A. Does this mean that maybe people on Wall Street will be making less? How will this affect their kind of investment strategy?
Well, the leadership of the banks are already guiding Wall Street to expect lower bonuses for this year. So they're sending out the signals that numbers will be down. I think it can mean a couple things. So of course, Wall Street is driven by capital activity, by IPOs, by debt offerings, stock offerings. It looks like those capital market activities are slowing for sure. Trading volumes have still been pretty high. M&A, it's interesting because sometimes in these recessionary markets, you do see actually consolidation as people look around and say, "Uh-oh, we're not growing anymore from organic means, so we've got to look at inorganic mergers, acquisitions, other opportunities, or we need to sell something that's less profitable." So I'm not sure that it's a negative. We'll find out what happens. And of course, if things get really bad, the flip side of M&A is the restructuring business. My former firm, Lazard, could prosper in good times and bad for that reason, because when companies start getting into trouble, they need financial help. Wall Street finds a way to make money sunny days or rainy days, but it does look like there is going to be some pressure on the financial markets.
Mm. So give us some of those inside tips. How do we do well in the rainy days, like they do well in the rainy days? Do we have to have some some inside information? Like, what should people basically do when we're living in a time of recession? Does that mean you need
Sure.
to
Well, I think,
stockpile
yeah,
food, like have hard assets? What should you do?
one of the things I've been saying for a while is that this year has been very, very difficult to predict where the markets were going to go. And my caution has largely been, and this is not investment advice, of course, but just sharing, some insights, which was to for retail investors, it's always tough to try to time the market to figure it out. I think this year has been particularly difficult. There's been so much volatility in the equity markets, up and down and up and down. The markets are already off, over the course of the year, especially in tech, quite a bit. We've seen some recovery in the fourth quarter. I would still be cautious. I don't know that we're through the pain. There's still a strong view out there that would say the bear market is not in yet. In other words, we're not done. We haven't seen the bottom. I think it's a time for caution. I continue to be very positive. Commodities, real estate, you said it, hard assets, things that you can bite with the teeth, so to speak. Gold, other commodities, even though gold has not performed well at all, I think gold stays yet to come. I think commodities generally across the energy complex, oil, gas, everything related, we still, even though gas prices and diesel prices have come down quite a bit in the last few weeks, if you look at global supply and demand and the ongoing conflict in the Ukraine, there are still going to be issues there. That's bullish for those commodities. And real estate, where I think, again, having income producing assets, having hard assets has some value. It's been a tough time for individuals because, of course, interest rates have gone up by 3 or 4% in the last year. That's hitting home affordability, which is already sort of being stretched because of the corporate presence buying up about 20% of single family homes in the last few years, private equity and other pension funds, other institutions kind of crowding out first time and other home buyers.